Good evening, friends, innovators, seekers of tomorrow. Let me cut to the chase. We stand at a crossroads, where the titans of technology reign supreme today, yet the forces of disruption are already aligning at their gates. There's a quiet assumption the world still believes in, that one currency, one monetary system, can remain the anchor for global stability, but every assumption meets its breaking point. And we're reaching that point now. The era of depending on a single currency for trade, reserves, or security is ending, not with panic, but with evolution. When you look at the data, the signals are impossible to ignore. The global monetary system has always moved in cycles, from gold to paper, from national currencies to digital frameworks. Each shift came when innovation outpaced policy. That's exactly where we are today. The system is strained not because it's failing, but because technology, demographics, and geopolitics are demanding something more adaptive, more decentralized, and more inclusive. Relying on one currency worked when economies were linear, predictable, and geographically bound, but in an era defined by blockchain, tokenized assets, and instantaneous settlement, dependence on a single monetary anchor has become a structural risk. We are entering a world where money moves as information does, freely, globally, without permission. That requires a new kind of flexibility. The financial architecture built for the 20th century cannot carry the weight of 21st century innovation. Look closely at what's happening. Nations are diversifying their reserves. Central banks are experimenting with digital currencies. Corporations are holding assets outside traditional systems, from Bitcoin to tokenized treasuries. Even individuals are seeking alternative stores of value. This isn't rebellion, it's adaptation. When a system loses its monopoly, it's not because people stop trusting money. It's because they start trusting technology. The danger in relying on one currency is not just inflation risk or policy missteps. It's concentration risk, the same kind that disrupts markets when one company dominates a sector. When power consolidates too tightly, resilience disappears. A single shock can ripple through the entire system. Diversification of currencies, physical, digital, sovereign, and algorithmic, isn't a threat to stability. It's the foundation of it. We must also recognize that innovation doesn't wait for permission. Decentralized finance, stablecoins, and digital payment rails have already created a parallel economy, faster, cheaper, borderless. They're not replacing the old system overnight. They're revealing what the next one will look like. When efficiency, transparency, and inclusivity rise, gravity shifts. Capital follows innovation. The traditional institutions that ignore this reality will be caught off guard. Just as newspapers underestimated the internet and retailers underestimated e-commerce, monetary systems risk underestimating decentralization. This shift isn't ideological, it's mathematical. Cost declines, network effects, and open access are driving the reallocation of trust. Money itself is being re-architected from centralized control to programmable ecosystems. But this isn't a story of collapse. It's a story of transformation. The future of finance will not be one currency to rule them all. It will be a network of interoperable systems, some government-backed, some decentralized, some algorithmic, all coexisting through transparency and trust. The winners will be those who understand how to navigate this plurality, how to allocate intelligently across forms of value. For investors, this means thinking differently about risk. Don't measure exposure just in dollars. Measure it in systems, in liquidity, in innovation. The assets that thrive in this transition will be those that align with the new flow of information. Assets that are verifiable, transferable, and borderless. The next generation of wealth will be built not by those who predict the perfect currency, but by those who understand that money, like technology, evolves. We are witnessing the financial equivalent of the Internet's early days. Skepticism dominates, but adoption builds quietly beneath the surface. Then, suddenly, the shift becomes irreversible. The same will happen here. The monetary future will not wait for consensus. It will arrive because necessity demands it. So as we look ahead, the message is simple. Resilience comes from diversification, adaptability, and foresight. The world cannot rely on one currency because the world no longer moves in one direction. The financial system of the future will not be centralized, it will be connected. And those who prepare for that reality will not just protect their wealth, they'll participate in the creation of an entirely new financial paradigm. That's not fear, that's progress. And the warning isn't to abandon what works, it's to evolve before it doesn't. In every era of transformation, there's a quiet truth that stands the test of time: real value endures. Technology changes, currencies fluctuate, markets rise and fall. But ownership of real things, things with intrinsic utility and scarcity, has always been the anchor. Today, as digital systems expand faster than ever and paper wealth moves in milliseconds, the reminder has never been more urgent: own what is real. We're living through an age defined by intangibles: data, algorithms, intellectual property, virtual assets. They have value, no question, but they're all built on layers of trust, code, and confidence. And confidence is fragile. When systems get stretched, when trust wavers, investors search for something they can touch, measure, and verify. That instinct is not outdated, it's timeless. Real assets are not about nostalgia, they're about resilience. Look at what's happening across global markets. Valuations have inflated on expectations of growth that may never materialize. Companies trade at hundreds of times earnings because we've priced in perfection. But perfection rarely lasts. At the first tremor of uncertainty, be it inflation, policy change, or geopolitical tension, the flow of capital starts to pivot. It moves toward tangibility, toward the assets that don't need quarterly narratives to justify their worth. Real things carry weight because they are grounded in fundamental demand. Land will always have value because it's finite. Energy resources will always matter because civilization runs on power. Infrastructure, metals, innovation-driven manufacturing, all these remain relevant, no matter how virtual the economy becomes. Even intellectual assets, when tied to tangible outcomes, hold power because they connect digital creation to physical impact. Owning real things isn't a rejection of technology, it's an embrace of balance. The future will be built on both digital networks and physical foundations. The data centers powering artificial intelligence consume real energy. The batteries enabling electric vehicles require real materials. The connectivity linking billions of people depends on fiber, semiconductors, satellites, each the product of real-world supply chains. Behind every software revolution is a backbone of tangible investment. For too long, we've been taught that the physical world is old-fashioned, that the digital revolution renders it obsolete. But when systems tighten, liquidity dries, or risk rises, only what's tangible can offer protection. Real ownership is not just about assets, it's about sovereignty. It's the ability to hold value outside the digital constructs that others control. Consider how the monetary landscape is shifting. As inflation and devaluation cycles reappear, owning real things becomes more than strategy, it becomes defense. Paper promises erode, numbers on screens can vanish with a keystroke, but tangible assets, productive land, precious metals, essential commodities, critical technologies, endure. They outlast the noise, they reset the baseline of trust. Owning what's real doesn't mean avoiding innovation. It means understanding where the innovation leads. The best opportunities are often where technology meets tangibility: autonomous energy systems, advanced manufacturing, robotics, space infrastructure, and sustainable materials. These are not speculative fantasies. They are the building blocks of the next economic era. Real value, amplified by exponential technology. There's also a deeper principle here, psychological as much as financial. When you own real things, you think long-term. You detach from the daily fluctuations and focus on durability. You stop trading sentiment and start building conviction. In a world chasing instant gratification, that mindset becomes a competitive advantage. Every cycle teaches the same lesson in new language: paper wealth expands, and then it corrects. Digital euphoria rises, and then reality grounds it. The investors who survive, even thrive, through each reset are those anchored in something more than narratives. They're anchored in assets that can't be diluted by opinion. This is not about fear of volatility. It's about freedom from dependency. When your portfolio, your livelihood, your confidence rest entirely on systems you don't control, you become vulnerable to every shock those systems face. Owning real things gives you leverage not over markets, but over uncertainty itself. We're entering a decade defined by transition, new energy systems, new monetary structures, new industrial foundations. Those who recognize this shift early won't cling to abstractions. They'll accumulate exposure to what the world actually needs. It's not a matter of speculation. It's a matter of alignment with the real economy. The next generation of wealth will be built by those who bridge the gap between the physical and the digital, between scarcity and innovation, because in every transformative moment, the most enduring opportunities arise not in what's virtual, but in what's verifiable. So when everything feels inflated, intangible, or uncertain, return to the core principle: own what's real. Real value doesn't vanish in volatility. Real assets don't need validation from headlines. They simply exist, working, producing, and enduring long after speculation fades. In the end, progress isn't about escaping reality, it's about mastering it. And those who own real things will not just preserve their wealth, they will shape the foundation of the next great economic transformation. Every generation of investors learns the same lesson, though most only after the damage is done. Diversification isn't a defensive strategy, it's a survival principle. Markets are built on cycles, innovation is built on disruption, and certainty is an illusion. When everything moves in one direction, it's easy to believe risk is an abstract idea. But risk is never gone. It's just hiding, and diversification is how you uncover it before it finds you. The most dangerous moments in finance are born from overconfidence, the belief that one sector, one technology, one region, or one narrative will keep leading forever. History has proven time and again that concentration creates fragility. The investors who chase momentum without balance are borrowing calm from the future, and the bill always comes due. Diversification is not about spreading yourself thin, it's about understanding that progress doesn't move in straight lines. Innovation moves in waves. When one curve matures, another begins. The challenge is not predicting every wave, but positioning so you're never fully exposed when one crashes. Whether it's currencies, commodities, equities, or digital assets, the same law applies. Resilience comes from variety. Look at the last few decades. We've seen dominant companies rise and fade, sectors transform overnight, currencies lose credibility, and entire asset classes emerge from nowhere. Each time the world was told, this is different. It never is. The names change, but the cycle repeats. Concentration feels brilliant during expansion, but unbearable during contraction. Diversification cushions both. It turns volatility from a threat into an opportunity. There's also a deeper reason to diversify. Innovation itself is uncertain. We live in an age of exponential change, but no one can predict exactly which path technology will take. Artificial intelligence, energy storage, genomics, robotics, blockchain, they're all converging. But at different speeds, the temptation is to pick a single winner and double down. But the smarter approach is to invest in the ecosystem that surrounds innovation, not just its headline, because when one experiment fails, another succeeds. When one model stalls, another accelerates. That's how exponential growth unfolds, through constant evolution. Diversification also protects against bias, our own as much as the market's. Every investor carries blind spots, emotional attachments to familiar assets, comfort in dominant currencies, nostalgia for past winners. These biases cloud judgment. They make us slow to adapt. By diversifying, we admit something crucial, that we don't know the future perfectly, and that humility is not weakness. It's foresight. In a world where data moves faster than decisions, concentration amplifies error. If you're wrong in one concentrated bet, you lose time and opportunity. But when you're diversified, mistakes become manageable, and successes have room to compound. It's not just about reducing losses, it's about increasing longevity. In the long run, survival itself becomes the ultimate edge. The global economy today is more interconnected than at any point in history, yet it's also more fragmented beneath the surface. Supply chains are shifting, geopolitics is reshaping trade routes, monetary systems are splintering, and technology is decentralizing power. No single market, currency, or asset can represent safety anymore. Safety has become a portfolio mindset, not a single position. The future investor must think in layers: real assets, digital innovation, emerging markets, and frontier technologies, all interwoven to balance the unexpected. Diversification doesn't mean abandoning conviction, it means structuring conviction intelligently. You can believe deeply in the future of technology while still owning energy infrastructure that powers it. You can be bullish on digital currencies while holding physical stores of value that hedge against volatility. True conviction doesn't need exclusivity, it needs balance. The best portfolios aren't the most concentrated ones, they're the most adaptive. Every great technological leap disrupts the last generation's safe havens. Railroads replaced canals, oil replaced coal, data replaced hardware, and now intelligence itself is becoming capital. Each shift creates new winners, but it also destroys complacency. The investors who thrive across cycles are those who accept that diversification isn't the opposite of conviction. It's what allows conviction to survive disruption. As we move deeper into an era of exponential technologies, global tensions, and monetary redefinition, protection won't come from standing still. It will come from moving with agility, owning assets that respond differently to stress, innovation, and time. That's what diversification really is, an architecture of resilience. In the end, the goal isn't to predict the next crisis or the next revolution. It's to be positioned for both, to own enough of the future to grow with it, and enough of the present to endure its storms. Because protection isn't about fear, it's about freedom. The freedom to stay invested, stay curious, and stay alive to the next wave of opportunity. Diversification isn't an act of caution, it's an act of vision. It's how you protect what you've built, while keeping the door open to what's coming next. Those who understand that will not only survive the volatility ahead, they'll define what comes after it. Every powerful transformation in markets, in economies, and in societies happens in cycles. Yet most people only see what's directly in front of them, the short-term noise, the daily volatility, the temporary headlines. They forget that progress doesn't unfold in a straight line. It moves in rhythms, waves, and long arcs that define generations. To think long-term is not to ignore the present, it's to understand its place within something much larger. The danger today is that speed has blinded us to time. Technology moves fast, information moves faster, and we mistake velocity for vision. But when you zoom out, you see that every major innovation follows a pattern: discovery, adoption, excess correction, and maturity. Those who understand the cycle don't get swept up in euphoria or fear. They recognize where we are, and they position for what comes next. Markets are emotional. They swing between optimism and despair, greed and caution. But underneath that surface lies something deeper: the long-term cycle of innovation, productivity, and value creation. Each technological era, the industrial age, the electricity revolution, the internet, began with skepticism, surged with excitement, and stabilized into transformation. We're in the midst of another of these epochs now, driven by artificial intelligence, energy storage, and digital decentralization. But it's still early, and early phases always feel chaotic. When you think in decades rather than quarters, you stop chasing returns, you start compounding conviction. You stop asking what will work this month, and start asking what will redefine the next 20 years. The short term is ruled by emotion. The long term is governed by mathematics and innovation. Every breakthrough begins as an outlier, every new market as a niche. But long-term cycles reward patience, not perfection. Investors who understand this view volatility differently. They don't see downturns as endings, they see them as resets. They understand that in every cycle, corrections are the price of progress. The market needs to breathe, to reprice risk, to shed excess. The greatest opportunities often emerge from those moments when others can't see past the noise. Because when everyone else is running from fear, long-term thinkers are planting seeds for the next expansion. Innovation itself is cyclical. It accelerates, consolidates, pauses, then explodes again when the next breakthrough reduces costs or expands access. You can't time that rhythm perfectly, but you can align with it. The companies, assets, and ideas that lead the next era are rarely the ones dominating the current one. The key is to recognize the inflection points before they're obvious, to look for the technologies on the verge of cost declines, the sectors ripe for transformation, the behaviors shifting beneath the surface. Thinking in long-term cycles also demands humility. It means accepting that progress doesn't move according to our expectations. Markets can stay irrational longer than anyone predicts, but cycles always complete. The euphoria of the crowd never lasts, and neither does despair. Every bubble, every correction, every disruption is part of the same pattern: growth through adaptation. The future doesn't reward the loudest voices, it rewards the most patient ones. Right now, the world stands at the convergence of several long-term cycles: technological, monetary, and demographic. The technologies transforming how we live and work are compounding exponentially. At the same time, the financial system is being restructured by digital currencies, new payment systems, and changing global trade dynamics. Demographics are reshaping demand, labor, and productivity. These forces don't operate in isolation, they intertwine. Their intersections create volatility in the short run, but enormous opportunity in the long run. The mistake most investors make is assuming the past decade will repeat indefinitely. It won't. Each cycle has its own character, its own leaders, its own laws of value creation. The companies and assets that thrived on one cost curve may struggle on another. The investors who anchored themselves to yesterday's winners will miss tomorrow's breakthroughs. Thinking in long-term cycles means staying open to the idea that what looks overvalued now might be cheap relative to its future potential, and what looks safe today might be the riskiest bet of all. Patience in this environment isn't passive, it's strategic. It's about building exposure to the themes that will compound over time: innovation platforms, real assets, human capital, and resilient systems. It's about resisting the temptation to react to every fluctuation, every headline, every correction. Because those who understand long-term cycles know that disruption doesn't happen in straight lines, it happens in leaps. So step back, zoom out, look beyond the daily movements of price and sentiment. What matters is not the noise of the moment, but the direction of history. The real opportunity lies not in timing the next quarter, but in positioning for the next era. Cycles will always turn. Empires, currencies, technologies, and markets all rise, all reset, all renew. The only question is whether you're prepared to ride those waves or be swept under by them. Thinking long-term doesn't guarantee perfection. It guarantees perspective, and perspective is what separates speculation from vision. Those who master the rhythm of cycles don't just survive uncertainty, they compound through it. They understand that every end is a beginning in disguise, and that the long arc of innovation always bends toward growth. The future belongs to those who see beyond the cycle's noise and trust its pattern, because in the end, time rewards conviction more than speed, and history always favors those who think long-term.